Hello everyone and welcome back to another episode. My name is Jordan, I'm a Millennial Investor, and today is always my favorite episode I get to make. I get to give you guys all the updates on my YouTube channel that I look forward to updating every single month, so let's go ahead and dive into it. You can see here first what we get to update for the month of November. On November 1st, our portfolio balance decreased slightly, just a couple $100. We went from last month's $37,000 change to this month's $36,738. My holdings is now updated. Salesforce did go up quite a bit because the stock price did rise, and Amazon tanked. Amazon had horrible earnings that took the share price down, so you can see my new pie percentages here. You can see my largest position being Salesforce, second position being Amazon, Crocs being the third one, and Google being in fourth place. This is for the growth portfolio. We're going to be going over the dividend growth portfolio in this video as well. And then we're going to talk about my performance. My performance so far this year to date, as of today, this is what we're looking like so far. My portfolio is down 13.5%. The only index that I'm not beating is the Dow. I am beating the S&P, which is down 17.7 as of the time that it was recorded, through my brokerage, which you can see right here, all these numbers, which I'm highlighting this little row right here that says year to date. I just inputted this into my chart so you can see it visualized. The S&P is down 17.7. The Dow is beating me at negative 8.4. I am far outpacing the NASDAQ, which is down almost 30% year to date. And then the Russell is down pretty close to the S&P, down 16.86. So we're still beating most indexes year to date, but that's how we're doing so far in 2022. We still got another month or two left. Now, this is my monthly YouTube income. We did have a great month. This is the most money I've made on YouTube. Actually, one of my highest months ever, pretty much my biggest since 2020. Now, my lifetime YouTube income is increasing as well with that $444 increase. We're almost to $7,000 now. And this all leads back into the portfolio, a mixture between investment gains, recurring deposits, and then of course that lifetime YouTube income increasing every single month, which reinvests straight back into the portfolio. Now, all those charts are great, and I'm sure you like seeing them, but what you're really here for is the portfolio. You probably want to see the holdings that I have in the dividend growth portfolio, and that's what we're going to get started. Now, if you want to support me, if you want to see this channel yourself firsthand, if you want to see the portfolio and invest in it, this is down below in the description. You can get signed up and get a free $10, and that's how I get a big part of this YouTube income, which is right here. So if you want to help support me, help support my channel, and get this portfolio to a bigger scale, get signed up with M1 Finance. It's a great brokerage. And without further ado, let's go ahead and get started into the dividend growth portfolio. And we'll start with the two biggest holdings, WP Carey and JP Morgan Chase. WP Carey is a real estate investment trust, or a REIT, that has went down like many real estate companies lately, and they're currently yielding 5.5%. Now, we'll kind of bundle these up with my other real estate investment trust with Realty Income, which is one of my highest viewed videos on the channel, which has over 30,000 views, where we talk about this company in depth, so check it out. I've made many videos about both of these, but essentially what they do is they collect rents and pay all the profits out to shareholders, basically all of them. They do dilute you as a shareholder. They do have to raise their shares outstanding, but they do that by constantly buying back new properties, and this is what leads their long-term revenue charts to pretty much just do nothing but go up and to the right. This factors in. Look at this chart. It goes back all the way to the 90s. This chart goes longer back than I've been alive. I'm 23. I was born in 1999. Look at the growth over the last several decades with high interest rates, with low interest rates, with recessions, all those different things that could happen for these companies. And many of these real estate investment trusts continue to go up in value, and I believe that these two are the highest quality. Check out my videos in depth if you want to see these companies further in depth, but long story short, I think that these are great companies with great dividend yields. Speaking of great dividend yields, JP Morgan still yields 3% despite this uproar that we've seen the last couple of months, and I think that the stock still has more room to run. A lot of people are worried about the economy for JP Morgan, and I get that a recession is scary, but yields are yielding amazing compared to how they've been over the last decade or so. So this revenue chart of right around 120 billion, I think could be exceeded as we see higher interest rates and they get more money off the capital that they have just sitting on the balance sheet. They can collect more interest off the money that they have, and more importantly, this is kind of a hedge against inflation and interest rates, because as interest rates go up, with those deposits being more valuable, that gives more opportunity for the stock to go up potentially. Lockheed Martin, speaking of hedges, this is almost one that's like a hedge against the war, against World War III. Because you look at this, the stock market might be down, but what is Lockheed Martin doing? That thing is going straight up. It's like a rocket. The previous all-time high before the war that we ever saw, this company traded at one point around 440. When the war was announced, everyone got really excited and they bid this company up to about $460. Today, it trades at almost $500, $482 as of today's close, and year to date, the company is up 36%, one of the best performers of the year, while paying out a pretty steady dividend of about 2.3%. And not to mention, they are planning on raising that dividend. They were paying out $2.80. They're about to announce another raise, which is due very, very soon from now. So stay tuned. I love Lockheed Martin. We did just make a video not so long ago about Visa, so check that out if you haven't already. But Visa is a long-term growth story. It's a company that does trade at a higher PE. It has a high premium, but it deserves to because the quality and the ratios behind Visa are just unparalleled against any other competition. If you look at the ratios here, let's pull up the ratios for this company, and actually let's pull up the annual. Yeah, we have the annual up now, so that way you can get an idea of how impressive this is. The profit margins are just ridiculous. They continually go up, and in 2022, they produced 51% profit margins for the fiscal year. 51%. Do you realize how insane that is? After all the employees they had to pay, after all the money they spent on research and development, all these expenses that you see right here, they spent, let's look at this. They spent $970 million on CapEx. Now on sales and marketing, they spent $1.3 billion. On G&A, which is general administrative, they spent $1.7. Research and development doesn't show up on this chart for some reason, but they do have R&D. Long story short, you get the point. This company has lots of expenses like many others out there, and they still have profit margins that are 50% plus. They bring in more in profit than they lose in profit. If someone hands them $100 in revenue, they keep $51 of that to straight profit. So that's why I love this company. It's still in a high growth category, and even though it's down about 4% year to date, I still think it has lots of room to run over the long term. The short term is a question mark, but over the long run, I think Visa is going to do great. Broadcom is one that used to be one of the biggest holdings in the portfolio. It's had a rough time like many semiconductor stocks, and the yield is starting to get pretty juicy. Currently sitting at 3.5%. They are due to raise that dividend this quarter because they always do it towards the end of the year. So stay tuned as this company is expected to raise its dividend, but long story short, the company is growing and they're transitioning from a hardware company to both a hardware and software company. They've made recent acquisitions, including VMware, and they're constantly reinvesting back into new patents, and you can prove this by speaking of that R&D that we were looking at earlier. This company spends a lot on R&D relative to its size, last year spending about $5 billion, and they're expected to keep that up moving forward, and the dividend growth over this past decade or so for this company has been ridiculous. You see here, going back to 2011. Actually, let's do annual so that way you can see this chart smooth out a little bit better. You can see that in 2010 it was 7 cents, raised it to 8 cents, up to 13, up to 19, 27, 38 cents, 49, $1.02, over doubled that year, $1.02 to $1.75, $2.65, $3.25, $3.60, $4.10, and then who knows what they're going to raise it at this year, but I'm assuming it's going to be another big raise, almost reaching $5 in dividends per share now. You can see Vici Properties is up next. I won't go over this too long. Essentially, the same thing as Realty Income, WP Carey. This owns pretty much the Las Vegas Strip. It's a real estate investment trust that pays out pretty much all of its profit to shareholders, and it's one that I'm bullish on. Trades at a pretty good valuation too, even with the company going up in share price. Home Depot is one that will be a long-term grower and one that will continually accrue shares into. The reason why I like Home Depot is because we are going into a recession, and this is a time where the housing market is going to struggle, and Home Depot's earnings is starting to reflect that. You see, despite its all-time high revenue, its free cash flow is pretty much stagnant. It's staying right around where it was in 2020. In 2021, last quarter producing $2.65 billion. Now that it's good that it's staying flat, but you can see that the reason this company has its free cash flow staying the same and its revenue is still still going up is because inflation is really starting to weigh on this company's margins. And you can see, because as time goes on, this company has been getting more efficient, but as of late, it has started to struggle. As you can see, its operating margins and profit margins are staying flat and not really going up pretty much for the first time ever. Now, this company's still a wonderful company. They're still buying back shares. They are still as well paying out hefty dividends, and they do raise it every single year, and they're due to raise it just in a couple months from now. But with this company paying out a higher dividend yield and having a stock price that is getting crushed, because if we pull this stock price up, you can see that year to date it's down 28%, over the last year down 20%, in the last 2 years it's basically flat. I think now is a good time to be acquiring Home Depot shares at $200 rather than buying at an all-time high of $400. So that's why we're buying Home Depot, and it's a core holding in the portfolio. Next up, we have Whirlpool, one that we've increased a lot because the valuation is ridiculously low. I mean, it is disgustingly low. It is just insane how low Whirlpool trades. If we look here on Qualterm Insights, the most recent PE, the forward PE is 9.25. That's pretty darn cheap for a company that has had stellar dividend growth. Grew at 25% last year. I'm going to repeat that just so you realize how crazy that is. It grew its dividend 25% year over year. They have made small acquisitions as well this year, and they're buying back just ridiculous amounts of share. Year over year, they bought back 12% of their company. They bought back 12% of the entire business just from the free cash flow that this company produces, and they still have a reasonably healthy balance sheet. The cash as of last reporting was $1.8 billion versus the debts 5.4. So it's not super healthy, but it's not crazy or anything. They still have plenty of room as long as they produce constant free cash flows, which they still are. They have struggled a bit, which is why you see this company come down in share price. But considering the all-time high about a year or so ago was right around $250+. Today it's trading at $130, essentially half that. The dividend yield is almost 5% just to sit and own it. I think now is a good time to be owning Whirlpool Corporation, and why we have it at 5% of the portfolio. A steady long-term grower and long-term compounder is Pepsi, and this stock, I mean, it's got to be one of the most boring companies in the entire market. Look how little volatility this has. Look during 2018, during the trade war. It had its little dip and then it recovered. You see 2020, it had its dip during the crash of 2020 and it immediately recovered. You see during this in 2022, you can't even really see the dip. It's kind of been a little wanky. It almost looked like a wave. It goes up, it goes down, it goes up, it goes down. But essentially it keeps on going higher and higher. It hits new highs every single time it goes up. And today we trade at basically the highest it's ever traded at 178. Now, while I don't like buying companies at the highest prices possible, Pepsi is one of the few exceptions because this company almost never goes down because their fundamentals, their actual business, never goes down. Look at their recent quarter. They produce revenue growth in a time where inflation is sky high because this is in fact the type of company that produces its own inflation. They raise prices. They can set prices whatever they want. If you're buying a bag of Doritos and it's $5, and then a year later that same bag of Doritos is $5.25, are you going to hesitate buying that bag of Doritos? Likely not. So that leads them to raising prices, having higher revenue, and then the free cash flow they just put up was a sky high record number of $4.43 billion, and that leads them to, you guessed it, raising dividends, buying back more shares just like you thought they would, and overall producing more shareholder value. This is a company that runs a little bit levered, but because the company is so free cash flow consistent, they never have a downturn, including 2020. When the pandemic happened, look at this. Let's go to the first and second quarter of 2020 right here. Pretty much consistent growth. Went from 12.88 to 13.88, increased to $1 billion. You see they had a slight hiccup from 16.45 to 15.95, like a couple percent down, but that's it. They had one bad quarter in 2020, but the first, third, and fourth quarter all had stellar growth, growing pretty considerably. And if you look at this on an annual basis, even in 2020, they grew the revenue from $67 billion up to $70 billion and never skipped a beat. Same thing for the free cash flow. They grew it from $5.4 billion to $6.3. So Pepsi is as consistent gets, and it's one that I don't mind buying pretty much at any price. I think it is a steady long-term compounder that's going to do great. Speaking of companies that are steady long-term compounders, this is one that is not really it. They have been it for a long time, and they're finally starting to face some headwinds. If we type in ticker symbol MMM, whoa, my keyboard's freaking out on me. Let's try that again. MMM. This company has had decent revenue growth, and if you look at a year-over-year basis, it looks good, but in the last couple of quarters, it's starting to stagnate. Year-over-year, it's down 3.6%. It's starting to flatten out, and the profitability is doing the same thing as well. It's starting to trend slightly downwards. So that's not good for shareholders, especially when a company like this pays out an already massive dividend relative to its size, and it doesn't have a super healthy balance sheet. It has quite a bit of debt. So this is one that deserves to trade down. The 5+% cash flow, or excuse me, the 5+% dividend yield that this company's paying out, while it may look juicy, it's well deserved that this company's down 45% over the last 5 years. I don't blame it. Now, it is one that I think can recover. They will turn around the business, but in the meantime, they're facing some major headwinds. And a pretty similar story to what we just said is the same thing for Altria. They have an insanely high 7.89% dividend yield, and they have been able to raise that dividend consistently year in and year out. But as you can probably tell, people and investors do not like smoking. And the one thing that this company has right now is major pricing power. People get addicted to tobacco products, and it is making them being able to raise prices and continually hit new all-time high revenue, which you can see right here. Ignore this left half of the chart. This is before the big spinoff that they had with their other tobacco business, but you can see pretty much from 2009 with the big spinoff, they consistently grown revenues, hitting a new all-time high here in 2022 at $6.5 billion. And then the free cash flow is doing the same thing, pretty much hitting all-time highs of $3 billion for the quarter. And this, once again, a company that can raise dividends, do share buybacks, and continually provide shareholder value, and it doesn't seem to be stopping anytime soon. Now, Altria is one that I'm concerned about future growth. I don't know how well they'll grow, but we'll stay tuned. We'll see if they're able to turn around the business, and in the meantime, you can get paid an astronomical size dividend while you wait. Target is one that we added in 2022. It is one that did face some huge headwinds. You can see this big drop where it dropped massively on its earnings report in May of this year, and it's pretty much traded flat ever since. Meanwhile, as time goes by, they've continually raised dividends. They just raised it 20% from 90 cents up to $1.08, and they pay out a pretty considerable 2.3% dividend yield. Target is one that I would consider to be high quality. They're one that has had great earnings per share and revenue growth, and it's a business that I think people like. People my age, if they're going to go out and shop, Target is generally speaking a company that people like, and they've had pretty decent revenue growth and profitability growth considering they're just a boring stock that's a brick and mortar retail business, and they sell boring things like furniture, groceries, and everyday household products that people take for granted. Now, the revenue growth has been stellar and the profitability has struggled, and that's why the share prices went down like many companies. For pretty much the first time ever over the last several years, they finally put up a big loss number in the beginning of 2022, and who knows how long this will take to recover. That said, I think that it will recover, and I think all-time highs is imminent. I think at some point, this all-time high of around 260, 270 will come right back. Now, I don't know when it is. It might be next month, it might be next year, it might be 2025, but I do think that Target will continue to compound its shares and its dividend and provide value to shareholders. Now, next up after Target, we have the company Kimberly Clark. This is one that has struggled to grow, and its share price has followed suit, only up 10% in the last 5 years. The dividend has rose steadily. They've had increasing cost, and that's the main issue that this company is having. If we go over here and we go to Kimberly Clark and we look at their gross margins, it's nothing that's amazing. It's a company, like I said, that has had a little bit of a struggles with its business over the last several years. Its gross margins has actually went down, going from its high in 2016 of 37%. Last year they put up 31. And if you look in 2022, where the same existing problems have stayed true through 2022, their most recent gross margin was 31. And if you look back in the pandemic, they were producing mid-30s of 34 to 36, even one quarter producing 39%. So today's 2022 margins of 29 to 31% is not going to cut it. This company's margins need to come back. This company's revenue growth needs to continue to stay tried and true, as it's a very slow grower, but it's one of the most boring stocks in the market. The good news is it provides stability in your portfolio. It's only down 13% year to date, not counting dividends, and it's one that you can rely on for the long term. Next up, you have Verizon, which is one that I'm not happy with, one that may be exiting the portfolio very soon. But long story short, Verizon is one that has struggled. It trades very much like a treasury bond. It's a bond-like company, and it pretty much will trade based off the 10-year treasury because right now the company is one of the most debt-ridden stocks you can find in the entire market. If something happens to Verizon's business, if something happens to this company or the revenue would start to tank, this company, I mean, I'm just going to be honest with you, they're going to declare bankruptcy. It is one that I have a small holding in the portfolio for good reason. Let's go ahead and take a look at the balance sheet. It's one of the most disgusting balance sheets you'll find in the entire market. If you look at the cash pile, it's a current, let's see here, it's so small I can't even get my mouse on it. It's $2 billion, which sounds great until you realize that the debt pile is $128 billion. Let's look at these side by side. Cash versus debt. That little bitty green line right here is the cash. That ginormous red line is the debt. So it's one that I'm not super confident in. I hate that it's gone down so much, and this could be a tax loss harvesting opportunity for those of you that hold this portfolio or this stock. But I think it's one that may just be better to reinvest back into our other holdings, take the loss, and walk away. I don't know. Stay tuned. We still own it for now. But we are getting that juicy dividend in the meantime. But right now, it's not one that I'm confident in. This one, Procter Gamble, I'll look pretty much the same thing as Pepsi. Even has a similar ticker symbol. It's one that's as steady can get. It's reliable, it's consistent, and I don't care what's happening with the economy. I don't care who's in office. I don't care what the Fed is doing. I don't care interest rates. I don't care what you're doing with your job. This company will grow revenue, period. This company will buy out other companies, they will grow their revenue, and they will grow their profitability over time. And you can see this apparently on a revenue chart ever since they had that spinoff in 2014, 2015, ignore that. Ever since this time in 2016 and beyond, they've been growing their revenue consistently, and they grew at 5% last year, which may not sound like a lot, but this is a Goliath company of $320 billion. They're consistently paying out dividends, as you guessed. They consistently grow it. Last year growing about 5% as well, the same rate of the revenue, and the profitability long term is trending in the right direction, which is what you want to see as an investor. It's one of the least volatile stocks you can own. It's a very boring company. This is not the type of company where you'll double your money in a year, but it's one that's consistent and boring, which a lot of times boring is good in the stock market and as an investment. This is the only energy play that we have. I normally don't go over this one too much. This is mostly a diversification play, a great dividend growth story that has been raising its dividend every single quarter, and NextEra Energy is one of the only energy companies that actually interest me. Next up, we have Caterpillar. Caterpillar is one that has had tough times in the recession until recently. Year to date, it's actually positive. As shocking as that is for me to say, we're actually up 5% year to date with the stock, and that's not even counting the dividends it's been paying out. And it raised it over 8% just in the most recent earnings report. And you can see that this company so far has been recovering nicely. That said, don't be surprised if this company goes down more. It's currently trading at about 215. Its all-time high is not that much higher at 243. I would not be surprised if this company went back down to 175, 150, because this company that is very volatile with the economy, I'm surprised with the economic downturn it's performed so well. So stay tuned. We'll see if that company turns down, but so far it's doing great. McDonald's and CocaCola, we just have 1% of the portfolio, and I look at these holdings the same. They perform so well, and they're trading at they're trading for premiums, honestly. In a recession, these stocks are starting to skyrocket because people flee to safety, and these are the type of companies they go to. And I will say, I do love these stocks, and I don't want to sell them, but I can't be buying them at all-time highs. And there are better companies that have performed better with worse share prices and have better opportunities to be buying these share prices and higher dividend yields now when we're in a recession. So they're not ones that I'm super confident on. But long story short, that's all 24 holdings in the portfolio. Of the dividend growth portfolio, that's all 20 that we broke down in a very quick manner. But this is my updates, and I hope it gave you guys a quick insight and gave you a realistic view of what a small-time investor's channel looked like. I know I only have a portfolio balance of about $36,000 as of the time of me filming, but I'm excited to see where we'll go in the future. I know one day I'll be making these updates and we'll have a $50,000 update, a $100,000 update, maybe even one day $1 million update, a long time from now. But in the meantime, if you want to help me, if you want to support the channel and you want to grow this, then you can check out M1 Finance, which gives you $10 for signing up and you to help support me, and I'd really appreciate it. But thank you guys so much for watching all the way to the end. I love you guys, I appreciate you, and I'll catch you guys next time.